Today, we will talk about Health Reimbursement Arrangement, HRA, what it is, how it works. A health reimbursement arrangement is an employer-funded plan that reimburses employees for qualified medical expenses and, in some cases, insurance premiums. Employers are allowed to claim a tax deduction for the reimbursements they make through these plans, and reimbursement dollars received by employees are generally tax-free. A health reimbursement arrangement is a plan set up by an employer to cover medical expenses for its employees. The employer decides how much it will put into the plan, and the employee can request reimbursement for actual medical expenses incurred up to that amount. All employees in the same class must receive the same HRA contribution. An HRA is not an account, and employees cannot withdraw funds in advance. Instead, they must incur the expense first, then have it reimbursed. A qualified small employer health reimbursement arrangement is a health coverage subsidy plan for employees working for businesses that employ less than 50 full-time workers. The yearly limits are set by the Internal Revenue Service, IRS. For 2022, a company with HRA can reimburse individual employees for up to $5,450 per year and employees that have families for up to $11,050 per year. The money that is reimbursed is tax-free for the employees and tax-deductible for the employers. An individual coverage HRA is a relatively new type of HRA that allows employees to buy their own comprehensive individual health insurance with pre-tax dollars. Employees can also use these HRAs to reimburse themselves for qualified health expenses such as copayments and deductibles. Whether or not an ICHRA makes an employee eligible for a premium tax credit to help pay for health insurance coverage under the Affordable Care Act depends on certain factors. Employers that continue to offer traditional group health insurance can offer accepted benefit HRAs to reimburse employees for up to $1,950 a year in qualified medical expenses. Employees can use EBHRAs to pay for short-term health insurance, dental and vision insurance premiums, and qualified medical expenses. HRAs can be used to pay for qualified medical expenses, including prescription medications, an annual physical exam, and much more. Additionally, employees can use HRAs to buy their own comprehensive individual health insurance with pre-tax dollars through the individual coverage HRA. An HRA only covers qualified medical and dental expenses, and certain medical expenses may be excluded by employers even if they are qualified by the IRS. The employer's list of reimbursable medical expenses will be outlined in its HRA plan document for employees. Employees with both an FSA and an HRA and an expense that is eligible to be reimbursed through both plans can't choose which will cover the expense. Compared to an HRA, a flexible spending arrangement is funded using a portion of an employee's pre-tax salary, while a health savings account, HSA, is a fully vested tax-advantaged account that is not subject to forfeiture if funds remain in the account at the end of the year. Employers determine the types of medical expenses that an HRA can be used for, and HRAs often, but do not always, reimburse other expenses such as copays, hospital expenses, and medical equipment. However, the IRS also excludes certain other expenses as being unqualified. The health reimbursement arrangement is funded solely by the employer, and any HRA money unspent by year-end may be rolled over to the following year. Unlike an HSA, the HRA does not go with employees if they leave the company to work for another firm. Employers get a tax deduction for reimbursements made through HRAs, and reimbursements given to employees are usually tax-free. HRAs offer predictability, allowing employers to anticipate their approximate maximum expense for HRA health benefits for the year. The employer determines the amount of money that will go into the plan, and the employee can ask to be reimbursed for qualified medical expenses up to the designated amount. A health reimbursement arrangement is a benefit used to pay employees back in tax-free money for certain qualified medical expenses and health coverage premiums. No. HRA money that hasn't been used by the end of the year can usually be carried over to the following year, with an employer determining the maximum amount that can be carried from one year to another. Examples of medical and dental expenses considered necessary might be an annual checkup, prescriptions, or substance abuse treatment. A health reimbursement arrangement is a tax-advantaged plan that employers use to reimburse employees for certain approved medical and dental expenses. The reimbursements paid to the employee are tax-free, and the employers can claim a tax deduction for their reimbursements. Here are 5 key takeaways. 1. HRAs reimburse employees for certain medical expenses and sometimes insurance premiums. 2. Employers, not employees, fund HRAs. 3. An HRA is not portable, employees lose this benefit when they leave the company. 4. Government rules determine which expenses can be reimbursed for employees. 5. Depending on the type of HRA, funds may be used to reimburse health insurance premiums, vision and dental insurance premiums, and qualified medical expenses. Hope this would help. Thanks for watching.